The Bear Roar's special edition series Bandwidth serves as a platform to celebrate the people and stories of Dan's book, Bandwidth, the untold story of ambition, deception, and innovation that shaped the internet age and dot-com boom. The story covers the epic journey of the creation of the internet's backbone, the building of the early competitive fiber networks in the 1990s, the bandwidth boom, bust, and resurrection, ending in 2020 when Dan's company Zayo was sold. The book is available on Amazon and Barnes & Noble. Head to dan-caruso.com/book for more details. In this episode of The Bear Roars, Dan Caruso sits down with John Siegel of Columbia Capital for a look back at one of telecom's darkest periods and the bold moves that helped revive it. John shares how Columbia bet on fiber in the aftermath of a full-blown industry collapse, why ICG's turnaround became a proving ground for future success, and how partnering on Zayo set the stage for one of digital infrastructure's most important growth stories. He opens up about the value of investor-operator trust, how Columbia's quirky culture helped shape his career, and why the AI revolution unfolding today feels eerily familiar. Let's poke the bear to kick off the conversation.
John Siegel from Columbia Capital. Boy, do we got some stuff to talk about.
We could spend, 2-3 days, Dan.
Yes, we can. So I don't know if this happens to you, but it happens to a lot of people. You have a nightmare in the middle of the night and you're trying to graduate from college and you realize you forgot to complete a course. And oh my gosh, you really didn't get that degree and your whole life's going to unravel and you got to study for the test, but you can't even figure out where the test is to get to your class and you go through a panic. I don't know if you've ever had a dream like that, kind of I never finished my college degree.
Oh yeah, in fact, I had one about a couple months ago.
Really?
Yeah.
So here's mine. And this usually happens when I'm awake, not when I'm having a nightmare. And this is true. And that is, what if Don Gibbs didn't introduce me to you guys? What if when he did, you guys were busy and didn't respond? Or we had a conversation and you guys were like, nah, this doesn't make sense. You moved on. So what if I never partnered with you, John Siegel, with Jim Fleming, your partner, with Columbia Capital, and with MC Partners as well? What if? I don't know what would have happened to me because it certainly wouldn't have led to the kind of positive experience I have had since then. A lot of people say, oh yeah, you would have figured something else out, but I don't think I really would have, not of this nature. Something would have happened obviously, but I don't think the course that kind of got set because of that and where it led for me personally and my family and my life. I don't know what would happen if that interaction didn't happen or didn't kind of proceed forward. So I got to start there by saying thank you.
Well, I guess a couple things before we get started here. First off, I feel bad and feel almost like this is going to be not as rich because Fleming's not here. So
yes.
My partner, Jim Fleming, and I, Jim hired me in 2000. And I think of the 3 or 4 most important meetings I've ever done or calls I've ever done. One was meeting Jim for the first time. One was talking to you when you left Level 3. There are probably 2 or 3 others. Meeting my wife. Probably.
I was going to bring that up. I was going to bring that up.
Meet my wife at a bar in St. Simon's Island would be one. But, in terms of people that have had an impact on me and people that I've learned from, you and Fleming, clearly I would not be anywhere close to where I am without the two of you guys. And that call and that introduction from Don ended up being truly one of the transformative things in my career as well. And certainly in the arc of our firm at Columbia.
Yep. And the reason Jim's not here is we were going to try to do it where you were here in person and Jim was on video, but then you and I would have been staring at our screens and just doing a hybrid wouldn't have made much sense. But we're going to do one with Jim, hopefully, if he's willing to do it separately.
It'll be way better than this, I'm sure, with Fleming on there.
It'll be way different.
It will. It will be.
Jim will get off on whole different tangents
100%.
And whole different stories. But Jim's kind of passions and experiences are interrelated, but also kind of, I think, unique.
Yes.
So we'll get different ones. So let's set the stage for where the industry was when we first crossed paths. So this is circa 2023, because it was 2024 that we end up getting the
2003.
Yes, 2003. Yes, 2003. I'm losing a couple decades.
Yeah.
So 2003 to 2004 timeframe, which led to our partnership really beginning in 2004.
Mm-hmm.
But what was the industry like in 2003 from the vantage point of Columbia Capital and John Siegel?
So the industry was, I think the best way to describe it would be kind of nuclear winter. You had gone from a period in kind of the mid 90s where the industry was kind of the telco industry. It was kind of a staid utility type business. Then all of a sudden, the connectivity that the industry was providing became the fuel for the internet, right? And that is one of the more transformative kind of technological kind of eras in human history. So as a result, you had this massive wave of capital come into and kind of euphoria into the industry, and people with business plans, people were getting valued in public markets based on CapEx spent. So the more money you spent, the more you would get kind of a 3x multiple on your CapEx. So the incentive was just to pound money into the ground versus create solid businesses. We all know how that ended, which was horrifically.
And the amount of money, so you mentioned it, by historical standards, it was unprecedented.
100%.
We think about the dot-com boom, which coincided with the telecom boom, but the dot-com was kind of the icing. The cake was the telecom. There were trillions of dollars being invested in handfuls of years, which hadn't happened in human history, right? I mean, that wasn't just the latest wave of trillions of dollars. That was the first wave of trillions of dollars being spent in a compressed period of time. And as you're starting to get to, the idea was the more you spend, the more you're worth.
Right.
Spend $1 billion, you're worth $3 billion. Spend $1 trillion, you're worth $3 trillion. It's like the gold rush was this notion that no matter how you spent the money, if you raised it and spent it, you'll get rewarded in the markets for being worth a whole bunch of money, almost without regard for what you actually did with that money. It got that out of control.
Correct. I mean, the incentive was to spend like a drunken sailor. Focus on business plans wasn't really there. And just, I think the metric I always going to go back to, I think there were 36 public C-like businesses or people in kind of competitive telecom at like 2001. Of those 36 companies, 35 went bankrupt. So all but one, and the one that did not go bankrupt, level 3, went through a series of, permutations and acrobatics on its balance sheet that really kind of impaired the equity for a while, and probably should have gone bankrupt at some
and
point.
Repriced its debt. I mean,
one
of the ways it avoided was creating enough pressure on those that owed billions of dollars. We owed billions of dollars of debt to, put enough pressure on them so they took 60 cents on the dollar, 50 cents on the dollar back. So we had enough cash to give them 50 cents on the dollar and reduce the debt load. So yeah, we didn't go bankrupt by Chapter 7 or Chapter 11 standards, but those who had investment in the company, both on the debt side and equity side, took huge haircuts.
Oh, absolutely. And effectively, it was an out-of-court bankruptcy restructuring. But there were probably I can't think of any industry I'm aware of over my investing career where you basically had 35 out of 36 public companies go bankrupt. In the boom days, I remember when I joined Columbia, I knew that we were at kind of a peak of the market when I looked at the Wall Street Journal back when we got printed newspapers, and the kind of the what's business section, above the fold in the Wall Street Journal, 5 of the 6 stories were about investments into communications infrastructure. Roll the camera forward 3 years, all of those are basically been taken to zero, and no one wanted to touch the space. It was viewed as uninvestable. The equity holders had gotten wiped out. The debt holders had gotten wiped out, and there were very few people either brave enough or stupid enough to still kind of wade in there. Hence the introduction, Dan, and that's where the beauty started right there.
And there was a combination of being both a brave endeavor together and a stupid endeavor
Yeah,
that we did
absolutely.
together, and we'll get a little bit more into that. But let me we're going to come right back to 2003, 2004 in a second. But let's look way forward in time for a second. And I would say since then, the type of cycle we just described has not repeated itself until now.
Yeah.
And now doesn't mean 2003. Now means late 1990s. There's this, incredible surge of money being spent, driven by a revolution that is certainly going to change humankind even more so than the internet did. That being kind of AI at the center of it, and we're in that same cycle again. Not the bus cycle, not the things will go wrong cycle, but certainly in the investment cycle as we were in that heyday of when all that money was being spent building out the internet infrastructure and the fiber networks to support kind of the internet boom.
Yep.
Is that the way you're kind of sensing it as well?
Yeah. I mean, it's you. There are these points in time. I was a history major in college, so I kind of tend to look back over different cycles. But there are points of time in human history where kind of something revolutionary is happening. People understand it's revolutionary. They want to play the trend, and whether it's the kind of discovery of the New World with kind of some of the British trading companies when people were coming to the States, whether it was around when the railroads were being built, both here domestically and in Europe, the amount of speculation that went on there. Clearly, when people began to understand the impact of the internet and what that would do to commerce and business models and the way that people interacted, again, kind of untethered enthusiasm. And now looking at AI, which is a derivative of the internet, but something kind of completely different in terms of its impact on kind of the next 40 years of humanity, you certainly feel that kind of enthusiasm and people understanding this is going to be really big. This is going to be, there's going to be a lot of money to be made here. But as a result, you get this kind of wave of investment in, and it will take us a while to figure out, who is right, who is wrong, and how all this plays out over time.
So now we're going to go backwards in time, but not just backwards to 2003. We're going to go a little bit further back. You've already brought up, Jim Fleming. We talked about Columbia Capital. Tell us about the origin story of Columbia Capital. Tell us about how you joined Columbia Capital, your beginning of your partnership with Jim, and what Columbia Capital was doing in the late 90s and the very early 2000s.
Sure. So we are a very quirky firm. We're very quirky individuals, as you know us personally. But we're a quirky firm.
I wouldn't put it. By the way, I would not put it that way. I mean, maybe there's a little bit. We all have our quirks, but no, I would say you guys are one of the strongest firms out there in our industry in terms of developing true, authentic, deep relationships with the people you partner with.
Well,
that goes what you guys are most known for.
Well, I appreciate that. And I think that really goes to the culture that Jim has built. But going back to the foundations of the firm. So the firm was founded really by 5 kind of entrepreneurs around the wireless space. So you take, even before the internet, the wireless business started in the United States, and it was very much a business model that people didn't quite understand and didn't appreciate the impact it would have on society. Again, you talk about these technological waves. And so the founders of Columbia had a variety of different experiences and backgrounds. One was a lawyer, a couple were lawyers around the FCC. One worked for the Providence Journal. One, I don't think had even certainly didn't graduate from college. His family was in the broadcasting business in Memphis, but they were all entrepreneurial and kind of around the Federal Communications Bureau when they were kind of coming up with the rules of the wireless space. And going back to that, the way that the initial wireless licenses were divvied out, the FCC would give a license to an incumbent, an RBOC in the space. And then the other, they would actually put up the kind of counterbalance license they would put up into basically a ping pong ball auction. So you could buy a ping pong ball like a lottery, and if your ping pong ball came up, you would win. And what people did to spread risk was they would sell fractions of it and trade fractions across this. The founders of Columbia basically got involved in that. One of the founders of Columbia actually won an auction for a national paging license. But they basically, what ended up coming out of that was consolidation of a bunch of those regional licenses. So they started an advisory firm to do so. And clearly, as they were doing that, they saw opportunities to invest money. So these guys put mortgages on their homes and started investing in businesses. Jim was working for a wireless company, met one of the Columbia founders. They brought him on board to help start really the institutional investing cycle. Columbia, those guys had a heck of a run kind of around the internet and wireless stuff. They all made a bunch of money. Jim and another partner, Phil Herget, kind of institutionalized the firm in Fund 2 in 98. I was working at Morgan Stanley, and at that point, we'd had a kid, wanted to get out of the city, so ended up reaching out to the Columbia guys. I met Fleming, and as soon as I met him, I was like, I want to work with him. Like it was.
What was it that drew you to him?
Everyone I was talking to, so I grew up in Virginia, wanted to get back to my roots, but everyone that I was talking to in the space, when you met them, were in suits that cost more than I was paying for rent and wearing ties that probably worth more than the car I was driving. I met Jim, and he had an untied pair of Docksiders and glasses that were kind of cockeyed like that. But he was a truly genuine and kind of humble individual. And I just kind of appreciated the ethos of what he was putting out there and joined. And we went in, and that was 2000. And then the bottom fell out of everything we were doing. And it was all hands on deck, not only Columbia, but throughout the industry. It was really rough tides. And hats off to Jim. I went to him with like, hey, look, I think there are a lot of assets here that we can accumulate because people are basically giving them away for free. But it meant going completely against the grain of what was happening in the markets. And we did it. And frankly, we were fortunate to work with some amazing entrepreneurs like yourself. But it really comes from the founding of the firm, which was a bunch of entrepreneurs figuring angles that people didn't see and then kind of building on that. And I think we kind of hopefully have carried that banner forward to today.
Yeah. And you guys have, the buy low, sell high, which means you have to often work against the grain. You got to work against what is the conventional wisdom at the time. But most conventional wisdom is good wisdom,
Mm-hmm.
but you're looking for where those moments of opportunity where what most people think, your thesis is the right answer is a bit different than that. And you guys have been really good at finding those opportunities to invest when others are maybe more reluctant or even fearful to invest, and then get into sell cycles when it's time to sell. And I think that discipline has been pretty self-evident as I've observed you guys over a number of decades now.
Well, I think I think the encapsulating the buy low, sell high, there's a story, I think you featured it in your book, but when we did the ICG deal, that was a business that had gone bankrupt once, was still public, was going bankrupt in the next 45 days. We waded in, clearly right in the back of you, but, we kind of very publicly went and took the thing private and bought it. And unsolicited, there was an investor that was very good, well-known in the industry, took time out of his day to call up Jim and tell him, you guys are going to die with your boots on. Like, I don't even know what you're thinking about. So he took his time out just to tell us that we were completely stupid. And that ended up being kind of a legendary return and started what was, multi-decade partnership with you and a bunch of people from that team.
Yeah. And as I reflect back on that, I know we had lots of confidence going into that deal, but I wonder whether all that confidence was as well-founded as it should have been, or whether things just kind of, because things worked out so well and so well so quickly from a financial standpoint. Now, to be fair, this was, we had to let go a lot of people. There were a lot of people who were employed there that, the company couldn't afford to be paying, doing things that the company shouldn't have been doing. We had to, act quickly and aggressively to get them out of what certainly would have been a second bankruptcy in order to kind of get the cash flow producing as opposed to consuming the available resource. So it was certainly from a need to turn around a company standpoint. It was a very strong story as far as a new team coming in and basically saving a company from what would have been a hard bankruptcy. But it did mean a lot of people lost their jobs, et cetera. But it also provided us the foundation to build something of significance. But when you reflect back on the ICG, I mean, things went so well. We would have those, it seemed like weekly calls where we started calling them, "What have you done for me lately?" Because every time we'd come into those calls, there were pleasant surprises and very rarely a setback. But it was one pleasant surprise, another pleasant surprise. We found a pocket of value here. We unleashed value there. Cash flows were better than we thought they were going to be. And it was like, which rarely happens any time in anyone's career where, it's a series of good news followed by good news followed by good news. But that's what it seemed to be. As you remember that time, how do you remember it?
Well, I think there were a couple big rocks that we needed. If you think about it like hopping across a river, there were a couple of big rocks that we needed to land on going across there. First off was to even contemplate something that, as hairy as that was, you needed to have an extraordinary management team. And we were uncovering these pockets of goodness, but we had an unbelievably talented and aggressive group of people doing that, and led by you and John Scarano, and really just kind of tearing through that and having the experience to understand where that goodness lay. Because remember, there were people running that business who were sitting on top of it who didn't see that. So you needed extraordinary talent and people who could be very decisive. So that was first. I think there were a couple things that we needed to break the right way. And I can remember one sitting on the floor of the Detroit airport on a call, and you talked about the lease that got renegotiated at the Death Star headquarters down in Cherry Creek. That was a huge one. And then, frankly, we found we had done a bunch of work, and you had done work, kind of lining up homes for some of these pockets of assets that in someone else's hands could unlock a ton of value, and at the same time would reduce our burn considerably, which, ironically kind of foretold the story of Zayo, kind of 4 or 5 years later. But having those relationships in place and being able to transact on them quickly, I think were, and again, with an extraordinary management team, it all kind of lined up in a serendipitous fashion to make that happen. But I guarantee you, if we had put 20 management teams to look at that business, we would not have found the pockets of goodness that you guys found because of the strength of what you guys had and what you brought to the table.
Well, I mean, thank you for that. I often am operating as an investor now, not as an operator. And I've noticed multiple times where the management team could gain a lot of value by openly partnering with their investors, yet are reluctant to do it. And I understand it. I'm an operator, and as an operator, you want to go get the job done. You want to own it. You don't want your investors to, necessarily be involved in things if you don't need them to be involved. But in the ICG experience, and Zayo too, but ICG experience, this was a true partnership between the management team and Columbia Capital MC Ventures. Like if I look at the Empower deal, which was really important, you guys did that deal. We didn't do that deal. We were part of it, but you guys were more in the lead role. We were more in the execution of what you guys were orchestrating behind the scenes. And that was one of a few examples where there were key parts of that whole execution plan where you guys were as instrumental, meaning not just Columbia Capital, but MC Ventures as well. You were as instrumental as we were. And no one was like worried about that. I mean, the management team wasn't like, oh, we can't let them do it because were the management team, and you guys weren't like, hey, we're the investors. We'll tell the management team what to do. We just operated as if there was not really a barrier between kind of what hat we were wearing. We had a job to do, and we figured out how to do it together. And to me, that was part of what maybe I didn't realize how special that was at the time. But as I got future experiences with various different investors, and as an investor myself, I could see how unique and special of a collaboration that was.
Yeah, and honestly, I think if there's one hallmark of our firm, that's the way we try to operate with people. Because I would love to tell you I've got a box under my desk with all the answers in it. I certainly don't. Mm-hmm. And the goal for us is to find really outstanding opportunities that really kind of fueled by growth, and then partner with management teams and to work with them in a collaborative way. Because if I'm coming at something where I feel like I've got all the answers, I guarantee you I'm going to come to the wrong one, 100%.
Yep. So we did ICG together. It was a short period. It was less than 2 years between when we really got going on it and when we completed the exit, which we sold the lion's share of it to Level 3. I wasn't going to go back to Level 3. To this day, I don't know if they wanted me to come back or not, because I'm pretty sure that there wasn't an office with Dan Caruso on it. But maybe not. But I did sign myself out of the deal, and no one seemed to notice, and no one brought it up afterwards. So I don't know if I made it easy on them or not. But certainly, the thought of kind of going back and trying to operate in that environment was not what my future held, and yet I wasn't ready to just kind of declare victory. We made quite a bit of money on that deal, and that was certainly, the time of my life I could have just looked at that and said that's plenty enough, and I don't need to kind of worry about that type of work anymore. But I felt totally unfulfilled, because I felt like we made money, but we made money by tearing apart a company, not by creating something. And my aspiration was to create something. So now we're sitting there in 2006. I had to get some medical work done. I had to get my hips replaced, actually. So I decided to do that during the closing period, which was probably a little selfish on my part, because if something would have required attention, I'm not sure I'd been able to do it. But I'm like, hey, everything's fine. They'll go through the closing process, which we did. I'll get through my recovery during that period, and start to think about, okay, what to do now. And at that point, there was starting to be a light at the end of the tunnel for our industry. I think we proved to our collective selves, not just the management team, but to the investors as well, that fiber has value. Fiber has long-term value, and providing bandwidth is a business model. Because prior to that, it was that was considered, and that's part of the way we made the money on ICG, is it was considered to be a toxic business model. That fiber was a liability, and bandwidth was a commodity, and you can only make money if you did these value-added services at the voice and data level, way high up above the stack, and selling retail to enterprises. And what we did is we went back to really the old Level 3 playbook and say, hey, we're building a multi-generational asset in fiber. The best way to extract value out of that is provide bandwidth and get really good at that, and you should be able to get a great return on your capital. So that became kind of the underpinning for Zayo. But to say it was that obvious at that time would be an overstatement, because there was still all kind of murkiness out there. The industry had not recovered at that point. But I think we had insight that the recovery had begun to pick up traction, even if most didn't realize it.
I think what you began to see was combinations of businesses. There were synergies to be had, and that these businesses could be profitable, right? So that was, now whether you were playing on the unbundled network element side or the fiber side, that was certainly the case. And so the sustainability of the business models began to kind of emerge 2-3 years after we started doing this. We saw early signs of it at Empower. Level 3 was beginning to stick their nose out and do the telco deal, and then we were quickly following after that. But the compounding growth of the internet. So the internet doubles in terms of traffic every year, and it still does now. Even now, it still does. But what you began seeing was you started burning through a bunch of this capacity, and then some of the business models that did not have access to fiber, they ran out of gas. So kind of the unbundled network element, the allegiance models, some of those, really you needed fiber to really fuel the growth to keep up with the bandwidth demand. And that gave you a leverageable asset. And that really began to emerge, I'd say kind of a view on that, some 2005 to 2008. And, hats off to you, because you were really, kind of very adamant on making sure we understood where we made money as a business. And I think a lot of people in our industry still have not learned that lesson of what is the asset you have, how do you leverage it, how do you actually drive cash flow from that? And then, other services, I think they can really muddy the waters in terms of, you can get a quick hit, like it's a sugar rush from eating a pack of M&Ms, like, I can get a bunch of growth, but if you don't have visibility on the true profit margins and the other costs that are burdening the business, you can lose the plot very quickly on this, especially this specific business model.
Yeah, and part of it, and I agree, there's still like a deficiency there to this day. I can't speak for broad other industries, but there's this focus on the word profitability. Okay, so we're profitable. And like, well, what do you mean by profitable? And people think of EBITDA. Okay, so EBITDA, our EBITDA is growing, therefore we're creating value. Okay, so your EBITDA is growing, therefore you're creating value. What does that really mean? Okay, because EBITDA is a measurement. I think it's an important measurement. I think it's more important than maybe there's famous quotes out there from Berkshire Hathaway about like EBITDA doesn't mean anything. It does mean something because it's telling you how much of your revenue, once you subtract out kind of cash expenses, how much is left over.
Mm-hmm.
But that's only part of the story. Because if your EBITDA is growing because you did acquisitions, does that mean you created value or does that mean you did acquisitions? That doesn't tell you anything close to a complete picture. If your EBITDA is growing because you spend a lot of capital, certainly you'd expect your EBITDA to grow, but did it grow enough? What's the equation that measures did you create value? And that, I talk about that a lot in the book and go into it more in the appendix, but at that time, that was still something I was trying to figure out because I saw all these people, and still do to this day, talk with enthusiasm about how much value they are creating. We're creating value. Our job is to create enterprise value. We're creating value, but they had no idea what that meant because they had no way of measuring it. It was very easy to declare success. It'd be like playing a football game and say, we're winning. You say, well, how do you know you're winning? Because, we got a great running back, and did you see our quarterback? And we tackled that guy there. Okay, yeah, those are kind of plays in football. You run the ball and you throw the ball and you catch the ball and you tackle, but how do you know you're winning? Like, well, I don't know. We think we're winning. We feel like we're winning. Well, feeling like you're winning is not winning. There's a score. Do you have more points than another team? And, when the game ended, did you end up with more points? And how many games did you win? We know those metrics, but in the business world, and it's like the operators don't know those metrics. If they're a public company, they say, look at the stock price, which if the stock price is up, they think it's because of how great of managers they are. But when stock price is down, it's because the market sucks. So they're kind of more of a chasing the stock price. What I began to kind of, the dots I began to connect were the private equity world. You guys value businesses all the time that are in your portfolio. I mean, every quarter you put a value on a business and you're trying to be really honest with yourselves because you want to know how a business is doing. So you're looking at what is the value of the business? What does that mean for the value of your equity? And how does that compare with what I invested? Did it go up in value based on kind of an honest introspection of your original investment and where you're at? And then you look at it at a portfolio level, and it's like, how do you apply that to running the business? And that's what we began to do. And at that point, you start to have to take into account the entirety of your investment and what you think the business is really now worth in a honest fashion, and whether you're growing that equity value over time. And I think once we had that, it started giving us the feedback loop we were looking for. I was looking for to guide whether you can objectively evaluate whether you're making progress in creating equity value or not.
Yeah, and I think there's a lot there to unpack, right?
Mm-hmm.
But I think the key element of that, as someone who is kind of involved in watching you kind of execute that playbook, was understanding what you were trying to measure. It's like it sounds super easy. It's like, let's understand what we're trying to measure. We think this is how you create value, and then actually put the systems in place to measure it and hold yourself accountable to it. And in our industry or any number of industries, actually looking at and understanding, getting to the ground truth on the data and what metrics really matter. There's a lot of FUD that can get tossed in there, and a lot of things that if you're not really looking for clarity, you can get distracted and you can destroy a ton of value along the way. And so that clarity and actually putting the systems in place to report and give you that visibility, I think there are countless businesses I've seen that just don't get that. Like, what core asset or what is core asset are you trying to leverage? How do you drive cash flow off that? And then if we add other things to that, are you adding or detracting from that?
Yes. Yeah, because most businesses that are capital intensive, when they're in a high value creation mode, like a very high value creation mode, they're almost certainly not generating cash. So you can't say, just look at your bottom line cash flow. That's a fallacy there, because by the time bottom line cash flow matters, that coincides typically when a business has begun to stabilize.
Mm-hmm.
It's when the Google search engine, began to move more in kind of the balance between harvesting, kind of being the number one search engine and spitting out a lot of cash, but also continuing to grow. But most businesses, when you're in that, heavy value creation period, if you try to measure bottom line cash, it's a big negative number. Does that mean the business is bad? No, because as long as you're truly fueling the right type of growth, you're probably creating a whole bunch of value. But if a business is burning a bunch of cash and not creating, it could look exactly the same on a cash flow line. You'd be burning the same amount of cash on a business that is destroying value as a business that's creating value. How do you tell the difference between those two? And that was part of the combined metric that we're trying to get at.
I'd love to tell you that I've got like the perfect answer for it, and I'm do it every time, and it's every time we stick the landing on that. I think it depends on the business model and understanding actually what customers want to buy from you.
Yep. And you use the word ground truth. It's part of it is searching for, not just an answer or data that supports what you want the answer to be. Like if you start with, we're creating a lot of value, now let's find metrics that I could share with others to convince them that we are. That's not really answering the question, are we creating a lot of value? That's starting with the assumption, we must be, because, it's like we must be winning the game. Let's figure out how to keep score afterwards.
Yeah.
But I think what investors should do and what management teams should do, but they don't always do, is, hey, we really got to start with an honest assessment, a ground truth, as you called it, as to, are we really creating value with what we're doing? If not, we have time to kind of address it. But if we're pretending we are and we're really not, a price will be paid sooner or later.
Oh, absolutely. Because the markets can look at a business and love you to death for a certain approach, but markets are fickle. Mm-hmm. And if you don't have a view on the way that value is truly created versus a narrative you're telling the market can flip on your narrative. And if you're not truly creating value or building cash flow or getting to a position where you're creating, high barriers to entry, a bunch of different things that are key levers in value creation, you can end up with a broken business and, kind of look like the industry did in 2000 very quickly.
Yes. So let's go back to now, it's 2007. We're starting Zayo. We don't have a name yet, but, we want to come off of our last venture.
Can we go to the Zayo naming?
Yeah, sure.
That might be my favorite Dan Caruso story of all time. And I've got a lot of them. So how do you remember the Zayo naming story? How do you remember that, Dan?
Well, so I remember having a board meeting. I remember we were going to start the board meeting by kind of introducing the group, the new name of the company, but which we already kind of were zeroing on the name Zayo. But we gave 7 names or so, and we asked the board members to put their top 2, middle 3, bottom 2. But I think I qualified by saying, after people started to pick their names, just as a heads up here, that doesn't mean that we're going to pick the name together, because we already have a pretty good idea of which name we want to go with. So you pick up the story from there. Is that part accurate?
So the part of the voting is accurate. I don't think the part of we've already chosen the name was fully kind of put out there for the board. So the way I remember the story is that we're in, kind of one of your board meetings, and we've gone through a bunch of metrics and value creation and, different deals we're doing, et cetera, et cetera. And then we get to a point where like, okay, it's time for us. I think the business had been called Communications Infrastructure, or CII. I forget what that last one was. And
Communication Infrastructure Investments.
Investments, yes, CII. And so you gave us like eight names. You said, top 2, middle 2, bottom 2. And we all voted. Some of the names were awful. I remember one of them, Jovio, was out there. And I think Zayo, amongst the board voting, might have been either dead last or second to last, if I'm not mistaken.
Right up there with Jovio.
Yeah, it was the only thing. Jovio was the only thing that was worse. And so we're all like, all right, so then it's going to be fiber or light, blah, 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 something. And so the voting results pop up, and you're like, well, sorry guys, I've already named the company. It's going to be Zayo. We're all like, okay. And that's pretty much the way you ran the business. That was good. Yeah.
Well, I mean, and I had a reason, a method for the madness that, that I think played well over time, put it that way. Maybe it wasn't so obvious, but it was, I had the idea of something nostalgic. And by nostalgic, I meant going back to the late 90s, before kind of the dot bomb, before the telecom meltdown. You had companies popping up with names like Yahoo. It wasn't, Google wasn't quite around at the time, but there were these like distinct names that didn't really mean anything but were memorable. So I wanted something kind of, distinct. I wanted 4 letters, because even at the time I had the idea that it would, be our listing on the stock exchange. So something catchy, and something you get a URL that you didn't have to pay a whole bunch of money for. And, sounds like basic criteria, but once you have that criteria, it's really hard to find a name. And all the other names we had were like this fiber company, that network company, and they would be abbreviated 3 letters. I'm like, that's what we want to get away from. That's the industry when it got into its doldrums. We want to go back when there was creative names. So that's what we did. And I feel one of the reasons I feel vindicated is Matt Erickson's company pretty much took the same idea, and they're called Vero. So instead of a Z, they got a V, and they still end in an O. So I think Zayo's stuck, and Zayo's, the new investors who came in and bought the company, they changed everything they could change, but they never changed the name, which is kind of nice.
Yeah, no, I mean, I've been in business meetings in some pretty far-flung reaches of the world, and everybody knows Zayo. It's a name that jumps out at you. So
I still think we're a jewelry company.
Yeah, well, it's better than Jovio still.
Jovio was my other name, by the way. And Scarano told me he would quit if I picked the name Jovio. Yeah. I said, well, that makes it even more tempting. Yeah, John was a great partner. Still is a great friend. John was a great partner. We accomplished a lot together. Okay, so take us through the early Zayo days from the vantage point of Columbia Capital.
So, the way that I kind of remember it was, you're basically laid up in recovery, have had hip surgery, and you're like hammering away on the business plan. And we start iterating with you on the business plan. And there's a series of negotiations that goes on. And ultimately we, us and MC Ventures and you kind of come together. And then we pulled some people into the syndicate. I think Battery came in and Oak Investment Partners came in as part of that syndicate. And the thought was, it was a pretty easy thesis. Bandwidth is growing. fiber is effectively the leverageable asset for that. There are a bunch of these distressed properties we can go out there and buy. And then if we put a great management team around that and extract some synergies, you'll get the benefit of cost synergies on the backside with great, kind of growth behind. And that was the thesis. We really liked it. We clearly were huge fans of you and John and the team. So, we were all in on it. Ironically, this tells you better lucky than good in the investment business. I think our underwriting case on that was, yeah, we could buy these, kind of polish them up a little bit. Maybe this will be kind of a 3 to 5x type return for us, which is a very good return in the investment world. Ended up being, far in excess of that. So thank you for that. But
well, thank you for that.
But that's how I remember it. And, I felt like you guys, the way you organized that team, everybody had a role. People wore a bunch of different hats, and you had just such strong athletes coming at the opportunity very tactically that once we looked at something, you could get in there, we could swarm it, we could figure out where the costs were, how it would fit. And it got to be a very repeatable process. But again, that gets back to the strength of the management team.
Yeah. And when we did the deal selling the remnants of ICG to level 3, remnants being, the majority of, but we had sold other pieces. We talked about, I wrote myself on that deal, but nearly all the other key members of my management team had to go with that deal. So from my vantage point, I didn't know if they'd go back to level 3 or go there for the first time, but most of my key people were going back to level 3. I didn't know that whether they would extract themselves or be allowed to extract themselves. So it wasn't clear I had a management team when we were iterating on that. So part of me was holding my breath. Do I have to go and rebuild a team or wait for people to kind of, extract themselves out of, out of level 3 again, maybe different people who I had worked with in the past, or, could we reassemble a team? And, and one by one, they would come visit me and say, what's next? And the other thing, this was a little bit of fun, and it kind of worked out better than I would have thought. But I also had the idea that we had this small building where we started Zayo where we did the ICG deal. We had this small building on Pearl Street. So I had the idea that we would sublease half the space to the portion of ICG that was going to level 3, but the other half of the space we would sublease, to ourselves, basically. So the small building basically got divided in virtual half, so that the people who would go to level 3 as part of the ICG deal could still show up in the same small office that we'd be in, and then be very easy to talk to each other about what's going to happen next.
Funny how that works.
And the nice thing is the sublease price that went to level 3 paid for the whole building. So our sublease pretty much was for free. So it was like a tiny, dot of a number. So it wasn't material in any way, but it was fun to reminisce about the start of Zayo, which became kind of the biggest rival to level 3. We started that in a small building that level 3 was paying for, and most people who were in that small building worked for level 3.
Yeah. Well, it's funny you talk about level 3. Just to double click on something, I know you've talked about in previous podcasts and certainly in your book, as someone who's been around the space for a long time, I'm still blown away by the collection of talent you guys had at that business at level 3. Going back pre-Zayo, pre-ICG, that was an extraordinary group of people, top to bottom. Not everyone was an all-star, but the strength of talent and intelligence in that business, Lord knows, we probably have had 6 or 7 level 3 employees serve as CEOs of our portfolio companies in a variety of different business models, a variety of different ways. It was just an extraordinary pool of talent, just unbelievable. And your ability to identify and pull people out, thank you for that, because a lot of people respected you. You may not have always been the most popular guy, but people respected your intelligence and knew that you were a value creator there.
Yeah, I wasn't good at winning popularity contests. Still aren't to this day.
No. I remember that on my first reference call on you, Dan.
So people who think back to where their frame of reference is MFS, which preceded level 3, they make the comments about MFS, all the talent that came out of MFS and everything that talent did. And if you look back at that early era, you think of people like Royce Holland, but there were dozens of people who trace their roots back to MFS who went off and ran companies. Same thing with level 3. We had the nucleus there, the nucleus grew, and then that tree sprouted into lots of people running lots of companies. But you also can look today and see lots of people running lots of companies in our industry whose experience was Zayo, not level 3. So there's another tree, including in your portfolio, who people are running the companies and they don't trace their roots back to level 3. They trace their roots back to Zayo. So there's that whole kind of add-on generation as well. And
it's happening again. And we've got 2 CEOs who are, they did not come from the level 3 tree. They came from the orange tree, the Zayo tree.
Exactly. And by the way, that's why I'm wearing this.
I knew exactly why you're wearing that color.
And do have a pre-announcement to make, by the way. This is not fully set yet, but it's kind of an idea that's germinating. And that is in 2027, that'll be the 20-year anniversary of Zayo. While level 3 can say that it started in 1997, so it'll be the 30-year anniversary of level 3. And arguably, you could trace back MFS's roots to Chicago Fiber Optics, which got started right around 1997. So 40-year anniversary. So part of what I'm kicking around with a few folks is maybe we have a 20-year Zayo reunion coinciding with the 30-year level 3 reunion, coinciding with the 40-year MFS reunion, all here somewhere in Colorado a year and a half from now. So stay tuned.
I think that's a brilliant idea. I would want to make sure that is a well-stocked bar. That's the only thing I'd say.
Yes, well-stocked bar in a big venue.
Yes, exactly.
There'll be a lot of people there. So if people are listening to this and you want that to happen, shoot me a note.
Yep. I'm in.
You're in. All right, we got 2 RSVPs right now.
Okay, perfect. But that'd be perfect. You and I. Like open bar with you and I, Dan. I think who would want to come to that?
Exactly. So other memories from kind of the Zayo journey, and then we're going to start looking at some branches and talk about EU networks. We're going to talk about Grant Van Royen, so other things you started to do in that time frame as well. But let's stay on the Zayo theme for a little while, and then let's talk about how you guys were also doing other really cool stuff in that same era.
Yeah. So on the Zayo stuff. So the question is, what memories do I have of Zayo?
Yeah. What as you reflect back, what jumps at you?
I tell you, some of the Zayo board meetings were like some of the more entertaining. I guess it's a low hurdle. I always felt smarter after a Zayo board meeting. Like there was always something we discussed, kind of looking at how to unpack value creation. An acquisition we were doing. There was a lot of strategy at that time around how we were positioning ourselves, and a lot of kind of 3-dimensional chess being played. One on how we're creating value. 2, how we would position ourselves for a variety of different acquisitions, which was a big part of it. The stuff you were doing around Salesforce at the time, which, Salesforce is a monster business now. We took some insights from what you were doing at Salesforce to really help us jumpstart some stuff we were doing at Columbia on the enterprise technology side, on how you use that technology. So every time I walked out of one of those board meetings, I was like, I learned something. And that doesn't happen a ton. The other thing,
that's more because you're learning to fish.
Well, yeah. I mean, again, I said it's a low hurdle, right? Yes. Yeah. So the other thing I'd say is some of the colorful interactions with some of the board members we had around there, from some of the different investors who may not have been kind of steeped in telecom and who would raise a point, and the conversations that would come out of that and the way you would lead those, I still chuckle and laugh about them. I mean, there's like,
I probably wasn't always the most mature CEO in your portfolio.
There's again, I'm going to go back to something I referred to earlier, that the first reference call I did on you, we were hiring you for ICG. I talked to this guy, you forget who it was at this point, but he said, Dan is one of the smartest guys I've ever met. He's got true insight, but he can be really hard. And I'm like, what do you mean by that? He's like, there's a saying around level 3, like you can be crucified. And I saw you crucify a couple board members in those board meetings, me being one of them a couple times. But I remember those, but they were always around, people trying to go back, pivot off of how value was being created. And, you had kind of a very much sense of where you were going and what true north was. And it was great. But boy, and the deal stuff, as an investor guy, especially Fleming and I we're deal junkies, right? And so all the permutations and how we kind of made that happen. How many acquisitions did we do in the early days of Zayo? 20?
Yeah, 20, then 30, then maybe 40.
Yeah.
But it was those first 20 that mattered the most.
Yeah.
And, well, let's talk about AboveNet, the most important one, and
Wow.
and how that kind of, Zayo would have been a good investment for Columbia Capital. It would have been a good outcome, but it wouldn't be anything close to what it turned out to be if we didn't figure out a way to get AboveNet done. If AboveNet would have gotten away from us, we probably would have been acquired ourselves at some point, or I don't know what would have happened, but it certainly wouldn't have been, around today and as a brand, as kind of one of the top 2 kind of pure play bandwidth companies, certainly in North America. None of that would be if it wasn't for figuring out how to get AboveNet done. What's your memories about the AboveNet dynamic?
We were talking about, kind of a few, at the beginning of the podcast, we talked about a few key people that you met who've changed the course of your life. That is one of those deals you can look at that really changed the course of an investment or really the industry, I think, and there was a lot of strategy around that. AboveNet was, and LaPerche was a great executive, clearly, from the ground up. There's the whole tree of people that came from MFS level 3, and then there was the MCI, kind of group that was around the industry and super strong operators, different background a little bit, kind of different ethos than kind of the MFS level 3 crew. And LaPerche was one of those. And, that was a really messy story. Like, the business had been public. It went bankrupt, like darn near everything else did. And then the books were a mess for years. Like in terms of getting clarity on an audit and actually what was going on, he had his hands full there for a while. And, while that business was, kind of healing and getting better, you could see what we were doing at Zayo. We were coming up and picking up a ton of steam, but we had a kind of a grab bag collection of assets, right? We had a bunch of these metro networks, and maybe we'd done a small regional long haul or something like that. But, MFN, AboveNet was kind of the crown jewel of metro connectivity, kind of with a little bit in Europe, but a ton here in the States. And that was, if you were going to win the game, that is what you needed to do to win. And so the way I remember it, we had done, the Series A finance. We did the Series B with Charles Bank that came in. Those guys showed a lot of kind of backbone coming in at a really difficult time in the market.
Yes.
And then, we raised, another round of financing to do the AboveNet deal. And that transaction and the game theory of the sequencing of how we were going to approach them, how we were going to line up financing, how we would, from the outside, begin thinking about taking out synergies and then actually going and do that. It was a very well thought out and strategized process. And it felt like we kind of had everything, and we had lined up everything to a certain point, and then we launched. And I remember I had a conversation with LaPerche at Metro Connect saying that we're going to send you a letter. And he was, visibly taken aback by that. But we were so prepared.
Oh, I forgot that, because you were giving him a heads up.
Yeah, we gave him.
Remind me that, because we wanted to
up.
give him a heads up before I sat down with him, so that he was somewhat prepared for the conversation.
Correct.
Is that the right memory?
Yeah.
That's
yeah.
right.
So I had breakfast with him at Metro Connect, and unbeknownst to us at the time, he was working on a take private.
Yeah,
in the background.
If I ever update the book and do another version, I got to include that in it because I had forgotten that detail.
Yeah.
Because we were so careful and thoughtful about how we were going to kind of orchestrate that, and that was part of the game plan.
Yeah, it was. And then I think we sent him something within the next several hours or next day, but we gave him. I thought it was the right thing to do to just say, hey, look, we think there's a lot of strategic combination. Just as a heads up, this is what's going to be coming at you. But he was working on something in the background, unbeknownst to us. So, and I could see physically. And I'm a huge fan of LaPerche. Love that guy.
We did one of the first podcasts.
Yeah, he's great.
With Bill,
it was great.
Awesome.
Yeah. He's great. A titan in the industry. So, but the preparation you guys had in getting ready for that and the strategy. And then I remember I went to the first diligence meeting we had in New York. And I believe we had a room of like 20 people or something in that room of figuring out who's on first, who's doing what, who's handling systems, how we were going to start deconstructing the business and really taking a sense of what synergies were there. And that was a very, very intense process and very well thought out and very well choreographed going into it.
Yeah, and our timing was so close to being too late that any mistake we would have made, not even a mistake, any hesitation we would have had, we would have lost the deal.
Yeah.
Without even knowing
Sure.
that we were up against a deal that was about ready to be signed had we not have stuck our nose in it. So, we all, and that's another example where, again, a lot of people listen to this, are running kind of companies, tech companies. That's another example where the coordination between the management team and the investors was essential for that deal to get
100%.
done, including with Phil Canfield, who wasn't quite yet an investor, but it was their money that was going to enable the deal to get done. The fact that we were able to trust and work with one another and orchestrate this where we each had a role. If us as a management team would said, hey, this is our job, we're just going to go do it, the deal wouldn't have happened. If the investor would be like, hey, management team, go off to the side, we're going to go get this deal done and we'll tell you about it afterwards, it never would have happened. It was the fact that we could really work kind of hand in glove to see through this, to strategize, and then, each have a role in execution that was essential.
And I think that it's a point that is probably easily glossed over, but there's there's that magical space where you get, true collaboration between a management team and investors where each is bringing something unique and they value the other side, and they're not walls or barriers of people. You're stepping on my turf. I'm a deal guy. I'm going to do this. And if you can actually harness that, no matter what industry, you can unlock a huge amount of value. But egos always get in the way, and people get territorial. But if you can kind of break through that, and it really takes trust to make that happen, you can get to a really kind of golden spot where you can make a lot of magic happen.
Yeah, and you mentioned Charles Bank. Mike Shea was a big part of that too. Mike was, when he joined us as the lead on Series B, I had met him a few times in the past. I think you were just getting to know him at the time. Maybe your paths crossed as well, but none of us really knew him, and none of us really had worked with Charles Bank. At least that's my memory. But he came in, and he was a big part of us too. He contributed a lot. He was, active and part of, everything we did, through going public and shortly thereafter. So between him, between MC, Columbia, Phil Canfield, the group really did a good job.
No, it was a real collaborative effort. And when that happens and it lines up the right way, you can do some great things. And, again, it felt to me like people were really, the key to that in my mind is people had to put their egos to the side and work for the kind of with a common goal. And when that happens, you've got people were way smarter than me around that room with some really good ideas, and we got to some good outcomes.
Yep. So let's talk about other Columbia Capital stuff. Especially ones that were kind of loosely related.
Sure.
We went to, I don't know where we had time to do this, but we spent time in what I used to call Eastern Europe, but quickly learned that no one called it Eastern Europe anymore. We have to call it Central Europe.
Yep.
And there was the GTS Central Europe
Yes.
kind of investment. There was the EU Networks investment, Brady, who we should spend a fair amount of time on. There was, Neil came into the equation with some of, related to those and some other things you did. There was Grant and Cologix. Tell us these other things you were doing that were kind of, loosely related to what we're doing in Zayo.
Sure. So, I mean, I think if you take a step back, we had real conviction around the kind of the thesis you were putting forward about fiber being a key asset, in kind of the growth of the internet. So we were true believers at that point. And again, not being the smartest guy in the room, like, well, if we believe that, well, then let's look at other geographies where we can run that same playbook. And so we made 2 investments in Europe, one of which was GTS Central Europe. And that was a collection of assets that operated in Poland, the Czech Republic, Slovakia, Romania, and Hungary. And it was owned, at the time we came into it, and there are some crazy stories around this. The time we came into it, it was owned by Khodorkovsky, who had been the owner of Yukos, got sideways with Putin, and then this was like one of his last assets. And we came and bought that, and we brought you into that, really kind of trying to leverage your knowledge base as we tried to rationalize that business. And
I wrote a check in that too.
You did?
I was
You did?
an investor in that.
you did. We did. I think, unfortunately, we came in at like the all-time euro high. I think we got hurt by currency on that one. And some lessons learned about the cadence between data centers and fiber. Like the data center ecosystem was definitely 5 to 10 years behind. And, the fiber ecosystem needs data centers and fiber to work to get that cadence that really gets the growth going there. So we probably were a little bit too early on that one. But we made some money on it. It was good.
It was a good outcome.
Yeah, it was a good
financially.
outcome.
I feel like, you always have those. It's funny how you always think you leave money on the table. And I certainly feel that way with Zayo, which is in some respects silly because we invested $1 billion in equity and took out $8.5 billion. But I still look at Zayo and say, man, that thing could have been, next level up from there. But I look at that. So maybe it's just every investor does that on anything they're involved with. But I look at GTS, I'm like, there had to have been a way for that to be, it's probably what, a 2.5 times outcome maybe.
Yeah.
But it's like, that should have been a, 5 times outcome.
Yeah, and again, that gets to the cadence of the data center stuff, because you look at what the difference between EU was. So that was GTS, some crazy stories around that, and just a great learning experience. And you added a huge amount of value there as we were trying to rationalize that business, which had been run by a bunch of like a bunch of different fiefdoms when we went in there. EU Networks was, again, some of the old level 3 mafia.
Yeah, and on the GTS, there was also kind of, and maybe this was the right answer, I still don't know to stay, but they were wedded in somewhat preserving the business model of, well, these are separate countries, they're separate networks, they're separate business models. They're really around kind of higher level services and kind of broader enterprises. And this part of the world, Central Europe, isn't ready for something that looks different than that. So there was this ongoing tension between wanting to maintain kind of, the approach that existed before we bought it, and the, kind of my bias, which was you got to see past that and realize this is really a platform to establish kind of early and extremely strong position as, the bandwidth provider. But you got to think about that as a region, not as a bunch of islands. And it's not just like thin connectivity and over time, opportunities to build out fiber, opportunities to kind of make bandwidth at the core of what you do. You're going to might have to be patient, but that will be in front of you over time. And that's where your focus should be. And, those two kind of, points of view couldn't get reconciled, and maybe shouldn't have been reconciled because Central Europe wasn't ready for that.
Yeah, I think you didn't have the data center infrastructure in Central Europe that was driving that, really strong bandwidth demand. So the way that market worked was a lot of the traffic got, we would call tromboned, traffic from Prague to Warsaw. A lot of that would go through like Frankfurt, big internet exchange there. And so Frankfurt became this huge data center market, and you didn't really see data center growth in Central and Eastern Europe until probably the past 8 years, which was after we'd exited the investment.
Mm-hmm.
So that was GTS. A lot of learnings there. EU networks, we went back to the level 3 well there. It was actually, we were talking about MFN earlier, that AboveNet, those were the assets when MFN went bankrupt. They had several handfuls of markets in the US, and they had 8 to 10 markets they had built in Europe and had spent well over $1 billion doing so. When everything blew up in the telecom meltdown, a bunch of those assets ended up getting bought by an Irish entrepreneur, a guy named Noel Meany, who went around and had some backers out of Singapore who bought those things. He then, the Singapore backers then wanted him to provide some liquidity, so he took the company public via a shell company in Singapore. They were running out of money. Seems to be a thesis or a theme that kind of runs through a lot of my investing. And so we came in, and part of the contingency on our investing money into the business was bringing Brady Rayfuse in, who had been running Europe for level 3 and had a bunch of other kind of high profile jobs at level 3, brought him into that. And I remember telling Brady at the time, I'm like, look, we're getting all these great fiber assets. This is going to be like shooting fish in a barrel. And it was the furthest thing in the world from shooting fish in a barrel. I mean, I think Brady will say it was, I think he was CEO of that business, I don't know, for 15 years. And the first 10 of them were awful, and the last 5 were great. But it was a tough slog. But ultimately, in that business, we had a ton of level 3 people around that too, many of whom are kind of around the industry right now. David Selby, who's at AWS, is there. Uwe Nickel, who's doing a bunch of fiber to the home stuff in Germany, was there. A bunch of really talented people around that business. And we took a collection of just basically abandoned assets and built a business on that. And what really kind of transformed that business, aside from Brady's singular focus on really kind of a single source of truth with looking at data, and that was really just a page straight out of your playbook, Dan, was we kind of attached ourselves to data center growth in Europe. And that really, you can look at what's happened to digital infrastructure. That really kind of propelled that business from a collection of abandoned assets, and we just rode that bandwidth curve, which was great. But an amazing job by that management team, and a ton of lessons there. And we brought Neil Hobbs in. I know you and Brady and Neil have done a podcast, and those guys are, I mean, you talk about 2 wonderful individuals to work with, just a ton of fun. And boy, again, learned something every time I went to one of those board meetings too.
Yeah, absolutely. And, when I came in as an investor on the EU networks, and at the time, Zayo was not in Europe. Zayo was US.
Yep.
It wasn't even in Canada. But when we did the AboveNet deal, with that came a strong and growing Europe presence, a big presence in London.
And we shared network in London.
Yeah, shared network in London. And, they started to do, the new AboveNet, the outgrowth of MFN was starting to do expansion in other parts of Europe as well. So now all of a sudden, you find yourself as kind of primary rivals. I find myself and Brady find ourselves as primary rivals with each other, trying to figure out what do we do? Close friends, kind of, EU Networks was sort of a cousin of Zayo. What do we do? And, I think I said it maybe in the podcast when I was with Brady, but, the national answer could have been, and perhaps should have been, a way of bringing those 2 together, extracting the Europe assets that Zayo had and put that together with EU Networks or something else. But I still wanted to stay, whether that would have been a much better path forward, and could there have been a path to do that or not? But who
We
knows?
danced the dance.
Yeah.
So,
But it worked out. I mean, it worked out obviously for EU Networks, and and Zayo Europe, which is kind of extracted from Zayo, mothership. But Zayo Europe still uses the Zayo brand, but now operates autonomously, still largely owned by Zayo. It's still thriving out there.
yeah.
I need to find an excuse to go visit the new team there and see what they're really doing.
Yeah. It's, it's Zayo Europe. And when you went into Europe, you bought the AboveNet assets and you did a couple other acquisitions
Several
there.
more, yes.
And bought some, and it always ended up that when you would buy that business, who was the bridesmaid on that? EU Networks was the bridesmaid on a bunch of those deals. Yeah, you guys built a really nice business over there too, or Zayo did. We did. It gets complicated, I guess, but
Yep.
but both businesses have done well, and both have ridden that kind of bandwidth, curve that you saw coming in the latter part of the 2000 aughts, and it's been great to see, and it's been great to see again a number of the people who were early days at EU, what they've done in their careers, and now we got Brady involved in one of our businesses again, and great to be working with him again too.
So let's talk about Neil. So Neil, had a role in EU Networks as board and board chair, I think.
Sure.
But tell us the other business you did with Neil at that time. I think it was Presidio, right?
Yeah, we did. We did a big roll up of Cisco resellers at the time. A business called Presidio.
And Jeff Tench was part of that. Another one of our.
Well, Tench actually came into something else we did with Neil. So what I would say about Neil Hobbs is he's probably one of the best evaluators of talent that I've ever been around, and evaluators of, being able to boil through the BS on, strengths and weaknesses of an individual. And frankly, I've had that gun pointed at me several times where he's told me, and when I wasn't behaving in a way or thinking about things in a way he thought was appropriate, and take a step back. It's like, he's right most of the time.
Usually when he starts to sense out with mate,
Yeah.
you gotta be careful what's going to be said next.
Yeah. So we work with Neil at a business called Presidio, which was a big Cisco VAR roll-up. That still remains the largest independent Cisco VAR. That thing's been bought, sold, taken public, taken private. It's a hell of a business. And we brought Neil in to run a division of that was kind of struggling. He had kind of fallen out of favor at EU. You had told me that's a guy that is really talented.
Not at EU, at
It's
level
at level 3.
Right.
And so when he fell out of favor at level 3, we quickly went and bear hugged him and brought him in. He turned that business around. And then I think Neil has been involved or chairman of at least 5 of our portfolio companies since then. You're probably the only person that he's got more board involvement than you. So we did a ton of stuff with Neil. We did Presidio with him. We did EU Networks. He came on as Brady's chairman, which was really helpful because that board needed some direction in terms of some of the investors. We all weren't kind of aligned as we were around the Zayo board, just because given the way that company came together. Neil was involved with Grant Van Rooyen at Cologix, which was a big data center business we built. Another level 3 alumnus. And then he worked with a level 3 alumnus, Jeff Tench, in a business in the Microsoft ecosystem that we built. And Jeff is now running a big chunk of the Vantage data center business now. So another kind of that whole level 3 fabric that we were kind of introduced to via you. But Neil he's been a tremendous partner and absolutely wonderful to work with, and a ton of fun to hang out with.
Sometimes too much fun.
Yeah.
Hopefully he's slowed down a little bit now.
He's a grandfather many times over now. He said he slowed down, but I'll wait to see. Wait to see.
Yeah, no, some of my most fond memories during the period of time when we had survived at level 3 the bankruptcy threat. So we hit the rock bottom, we scraped the top of the trees, but then we had to get on and start getting the business to work, and that's when I I developed a very special relationship with both Neil and Brady, and at least from my vantage point, the three of us together kind of saw things very similarly. We were very focused. We were very much all like-minded in terms of you focus on execution. You stop thinking big thoughts. You make fun of politics. You don't get sucked into politics. You don't waste time with things that are distractions, including people that might be distractions, and you just plow forward. And I think we led by example. We plowed forward. We brought a lot of people with us who helped us do that. A lot of them were the names you've mentioned, and the way I look at least, everyone has different versions of how they remember kind of critical points in time. But I think that partnership was probably underappreciated in terms of how important that was for level 3 to get back on a really good track.
Well, the one common thing across all those people who are super talented, and also I would put Scarano in that mix too,
Yes.
by the way, 100%. And Lord knows I've worked with John on probably 4 or 5, 6 things now as well. He is another super talented level 3er. And what I would say is...
And I'm still going to get him on this podcast, by the way. I keep telling him I want him on it, and he keeps saying, yeah, but he hasn't said it.
All right,
but
you're going to have to need like somehow Hobbs and Brady got through here without much cursing. I think with Scarano, who knows what's going to go on with that. That definitely is a glass of wine podcast. But the unifying thing across all those talented people that you just mentioned, all of them left level 3. Either were walked out the door or left on their own. They just got frustrated with it, which is staggering to me because all have gone on to be super successful executives who had a vision of value creation, but they just couldn't exist in that environment, which is fascinating to me. I mean, you think about what you did at Zayo, what Brady did at EU, what Grant's done at Cologix, and now, with some of, he's gone on in the data center space, what Jeff's done, what John's done,
what Surreal's doing.
Yeah, Surreal is another one. I mean, it really is fascinating. You had this, it was like, the 27 Yankees of talent in this industry, and it couldn't exist together, but once kind of unleashed on the industry has created massive value.
What's funny is all the names you just mentioned, though, we could all coexist together.
Yeah.
Because we were all kind of joined at the arms. I mean, not that everything was hunky-dory at all times, but that collection of names you said, I can't remember, anything that was remotely an uncomfortable experience amongst those groupings of people. There was, other things that were at times uncomfortable, and part of it was we all been through a lot. I mean, Jim. I mean, for Jim to get through everything he got through, and the pressure he was under, and he was extremely strong in some ways. He had his blind spots. Kevin, everything he's been through, and he was there in all the good times and all the tough times. I mean, we all grew up together, and we had to figure things out. And a lot of us were better because we went through really tough times together. But that doesn't mean that while we were going through tough times, we weren't bouncing, off walls and hitting the ground really hard, and and sometimes not seeing things the same way. But Kevin's he's still very active doing some really interesting things, and Jim's since passed. But everyone should be proud of what we created, even if at times it was very difficult.
I mean, even we talked about a little bit the gyrations around the balance sheets, what Sunit pulled off. Yeah, the balance sheet,
and Sunit's doing great things too. Sunit, they're still very close. And he's on the board now of Crown. He just took Ibotta public. Actually, he's CFO at Crown Castle now. Yeah. So Sunit's another one.
Another super talented individual. I mean, it was a great collection of talent.
Yeah. And I'll put a little bit of plug in for my former Zayo team, if that's okay, because somewhat similar situation with Zayo, and that
absolutely,
and that the Zayo team that built Zayo, ran Zayo all the way, was there at when we sold it from a public company, took it private. Extremely talented group of people, but they all scattered and are doing other things now. Very few of them, you can almost trace it down to a small handful of names, are still there at Zayo, but the people who left are doing great things. Some of them in your portfolio, running companies, being part of other teams, in leadership roles throughout the industry. And yet from the vantage point of kind of, the newer owners of Zayo, they thought they were bringing in kind of a new set of people who were stronger than what was there. And, I think the talent that dispersed from there, I think Zayo still hasn't fully recovered from that.
Yeah, if I think of kind of the next generation of fiber providers, like the real drivers of those businesses, the four I would point to, all are Zayo alumnus. You look at the data center space, you've got Housen, who's, doing great things at Manage. You got, they're Van Rooyen is not a Zayo alumnus, but I mean, the folks.
I'm Chris Morley. I know
Oh, yeah,
that's
Morley.
one.
So I've got
Morley All-Star,
Erickson
All-Star.
Morley, Erickson, Noah, they're second generation Zayo guys, but Noah and Bruce Garrison. I mean, they're truly, great executives that really get the business really, really well. And then you've seen guys like Steinfurt go on and, he's having huge success in his career.
Yeah. A lot of talent. Sandy Mays, I would be remiss for not emphasizing Sandy. Sandy, I think, was probably the most underappreciated, executive throughout her entire career, including by me, because I didn't really know her well until the later years of Level 3, even though we worked together. She joined Level 3 early. We knew each other at MFS, but it was only in the latter years of Level 3 that I started to realize how talented she was. And she was a huge part of ICG. I think she was an underappreciated, part of that turnaround because she was doing a lot of the really hard stuff that was happening behind the scenes that many times other people would get credit for. She was a gigantic part of Zayo's success throughout its entire history, and she's, I think, definitely in the camp of a talent that people didn't realize, the role she really played and what she really brought to the table.
I kind of remember her as like employee one or something like that. I mean, she was pulling decks together for you super, super, super early in that.
Yeah. She was certainly part of the founding team.
Yeah.
So talk a little bit more about Grant Van Rooyen and the CoLogix experience. And, he's had incredible success as well.
Yeah, totally. So Grant Van Rooyen was...
And Grant, by the way, is scheduled to be on here.
Oh, is he really?
I think he's scheduled, right?
Oh, my gosh.
Is Grant scheduled? I know we had penciled in a date.
Oh, my gosh. Okay, that's great. So he is a very driven individual. Grant is very smart, super commercial. I can remember the first time I met him, I was at a meeting at Level 3. We were, Rand Lewis and I, who was at Centennial at the time, we're looking at trying to peel out some data center assets from Level 3. And I came into a meeting with Grant Van Rooyen and Jeff Tench, and then Jason Booma, who's in another Level 3 alumnus, who's one of my partners, clearly one of the smarter guys at Columbia. Again, another low hurdle. We go into this meeting, and Van Rooyen and Tench proceed to heckle and ridicule Rand and I for an hour and a half. And I left, I'm like, who was that guy? And lo and behold, he ends up being a very good friend of mine, super smart, just like Tench is, and a really crisp and sound business thinker. And so we looked at a couple different businesses with Grant early on, kind of like we did with you. We looked at a couple of businesses with you we ended up not doing. Same thing with Grant, and we ended up landing on kind of a business. And this is my partner, Patrick Hindy, who was doing a ton of work with Grant. And really, Patrick was the driver of this from CoLogix, from a Columbia standpoint. I was really way far in the background there. Grant and Patrick kind of landed on a data center model which was focused on interconnection and kind of interconnection in tier 2, tier 3 markets. So Equinix and Telex had kind of grabbed pole position in the big important markets globally or domestically too on, how networks handshake together. The profitability and durability of those business models, I wasn't really that clear on until Patrick and Grant started unpacking it for me. And we looked at what those guys did, and we went in and Grant spearheaded it, and we bought 4 or 5 assets and built a business around kind of interconnected co-location, which now is a thesis well known and kind of well put out there, but it was very nascent at the time. I think people knew what Equinix was doing, but didn't really see kind of a tier 2 place. A company called Switch and Data had tried it and kind of not done really well.
Oh,
with
that's
it.
just right. Another name we didn't bring up, level 3 alum that did fantastic things, was Charles Myers.
Oh yeah, Equinix. The whole
In fact, Charles, I think, is scheduled for this too.
yeah. So that whole Equinix, there's a whole Equinix tree of level 3 guys, Strohmeyer, Charles, and Sarah Bach, all those guys, right? So that's a whole nother group of talented people that were in level 3. But anyway, so we grew that business with Grant, again, with several level 3 alumnus. Fantastic outcome. Ended up selling that business to Stone Peak, which is a big infrastructure fund, who then coincidentally we partnered with at EU Networks, and also who took a run at Zayo at one point. So big players in the digital
It's an
infrastructure
understatement.
space.
Took a run at.
Yeah. And so, but Grant built a unbelievable business there, really kind of understands the data center space, kind of took a view of networking and applied it to data center, which I think was unique at the time. But you look at the people who have made the most say in that model, it's Van Rooyen and Myers and that team that came out of level 3. So,
Yeah, when my last couple of years at level 3, I took over I don't know what they were called before I was there, but they got termed by me, I think, as lines of business, because it was the marketing organization. This is my memory; could be half accurate, half inaccurate, but it was kind of more of a traditional marketing organization in a telecom structure. They would speak with a loud voice, but no one would really pay attention to them. They just do pricing, they just approve deals. They didn't really have a lot of kind of say in what was really going on in the organization, because they didn't really control the budgets, and most of the people worked either in sales or in the operation network side of the house. So this was at the point where we were trying to get the company back on track, and for whatever set of reasons, I was put in charge of the lines of business. And my philosophy that I developed quickly is this organization needs to play the quarterback function, because they should be seeing all the cost side of the business, but they need to see it all the way through to capital, and they need to see the revenue side of the business. This is where it needs to come together at kind of the day-to-day working level. The CFO organization doesn't do that. They keep track of the books. They work with external markets. But when it comes to how we really matching up revenue, cost, capital, if the lines of business aren't doing that, no one's doing it. And that's, at that point, Grant was early in his career, as I remember it, early at level 3. Jeff Chench was early in his career, early at level 3, spoke with a loud voice. Both of them were bursting with energy, but junior. Charles Myers was, he ran one of our groups, the voice group. He didn't directly report to me, but at the same time, he was part of the scope that I had. So it was kind of somewhat of an awkward relationship in that he hardline reported, the same guy I hardline report to, but sort of dotted line reporting as part of the line of business, because we need to do things in a coordinated fashion. But the talent in that group that got unleashed.
Booma was part of that group too.
And Booma was part of that too. But that's where, I think all those careers kind of hit a big acceleration mode, because we were really focused on understanding how the math of the business worked. How are we going to really create value?
Getting to the ground truth of where you create value.
Yeah. And Grant was doing that in the data center and internet area. Jeff was doing that in what we call transport, which was wavelengths in particular. John Sgrano I brought into that. He was working on the intercity fiber side of it. Brought Glenn Russo into that. He was doing the metro fiber. So that broad team across each of these lines of business, we were just going deep into colo, deep into how the business of the internet really worked, how the business of transport really worked, how the business of dark fiber really worked. And that really was kind of the training grounds for what I think a lot of us went off and did after that.
Oh yeah, it's that going to the ground truth and that understanding of the business, that fundamental kind of piece by piece understanding of where value lies in a business. Everyone that came out of that organization, you got a top tier MBA in that approach, and all have gone on to have huge success. All of them.
Great. So digital infrastructure, circa 2024. So let's get to present day. I don't know if you know this, but you must know because you're still immersed in digital infrastructure, but there are new upstarts here in Colorado that are blowing my mind. I'm going to drop a podcast. When is HydroHost being dropped? Is that next week? Are you familiar with HydroHost?
Nope.
So you're gonna hear this description of a business, and you're gonna be like, and the guy who's going to describe it, who's extraordinary, he's going to describe it as if this business model never existed before. Came up with the business model, and you're going to hear it, and you're going to say, that guy wasn't even born when we called that managed services. That guy wasn't even born when we called that hosting.
Yeah.
Maybe not hosting, but so what he's doing with GPUs is basically has put an infrastructure in place where on one side of that market is really the data center providers who are willing to invest the capital in GPUs, but they don't want to be like, how are we going to get people to use GPUs if we don't sell the capacity to Microsoft or an OpenAI? So we want to make more money off of it by owning the GPU infrastructure and have enterprises use that. So the other side of his marketplace are the enterprises that want access to GPU capacity, but very hard for them to get it. It's a constrained resource, and they don't really want to have to manage everything associated with that. So his infrastructure is in the middle of that creates all of the ability to, on one side, just say, I want to use GPUs, does all the commerce work and connectivity work in between. The other side are people who own the GPUs, but don't want to do what you need to do with them to make them available to individual customers. And he's built a thriving business out of it. He's already up to hundreds of millions of revenue, big valuation. And there's ironically another company here, which you must have heard of by the last name of, that uses my last name. Have you heard of this?
Yeah.
Robinson Crusoe,
Uh-huh.
the different spelling, but they're a multi-billion-dollar business. That's a data center model. So there's a whole new generation of digital infrastructure that's been created in general, but a lot of it's right here in the heart of Colorado.
Yeah, no, absolutely. I think we're probably past Internet 2.0. We're probably at 3. And what is happening in and around infrastructure is it dwarfs what happened in the 90s. Really,
Yeah.
it's fascinating, and it's putting.
Well, let's because we started this podcast and we talked about how big of a change happened around the creation of the internet. How money flooded in, you were getting rewarded for the amount of money you spent. The more money you spent, the more you were worth, with a 3-to-1 exchange ratio and this and that. And that hasn't happened again since until what's happening right now.
Mm-hmm.
And that doesn't mean it's bad, because the reason it happened, when there were 2 reasons that I would say it happened around the internet, and you sort of touched on this. One, because we all figured out at about the same time that the internet was going to change everything.
Yep.
So there wasn't like a group of people who thought so and a group of people who didn't. So it wasn't like an investment thesis that's somewhere on one side of the bed and on the other. We all agreed the internet was going to change everything, and we were all right. The internet changed everything. So it was that we all agreed, and we agreed because it was undeniably going to happen, and the clarity that happened all within a short period of time, a small handful of years. And the other element was there were other factors around it that were further feeding the frenzy, which was wireless, which you talked about, which was fiber. Fiber as a technology was blossoming at the same point in time. So these the unleashing of competition for bandwidth, for phone traffic, that all happened about the same time, and those fed off each other to create this frenzy that did in fact change the world. Now, fast forward today, and we all agree, and we're all going to be right. Anyone who bets against us is, I could say stupid, but I don't think you'd find one person in this category. Gen AI is going to change humankind forever. I think there's no denying that. It's happening. It's obvious to all of us. We're all on the same side of that bet. And there's other things around that are also powerful forces. One that's maybe, less familiar to you, more familiar to me is space tech. What's happening in the space economy, is happening so quickly. You hear a lot of people talking now about creating funds, investing in defense tech, and defense tech, is space and it's cyber, but it's also one other big category, which is quantum. And I got very interested in quantum as I was leaving Zayo. Quantum is going like crazy now. Many companies worth billions of dollars. Many companies are clipping $10 billion, and none of them existed 5 years ago. And then robotics is a big part of that as well. So you have at the core Gen AI, quantum, space tech, robotics. This whole nother wave is coming of just world-changing activity. And digital infrastructure is still at the core of a lot of that. How do you look at today's environment, both from the vantage point of digital infrastructure, but also the vantage point of, of how big of a new transformation is in full force?
Yeah, I think it's tough. It's really, there's a old Indian proverb about, 8 blind men around an elephant, right? And, one of them touches the tusk and says it's a spear. One of them touches the trunk and says it's a snake. One of them touches the leg and says it's a tree, et cetera, et cetera. And, it is really hard for an investor, especially a specialized investor, to take a step back and tell you about the whole elephant. I can tell you about the areas in which we specialize, and we do a lot of stuff around space, especially as it relates to satellite because of our wireless practice. Do a lot of stuff around digital infrastructure, clearly. And then we're talking about Jason Booma earlier. He does a lot of stuff around enterprise technology and, kind of the application of AI. So inside the universe in which we play, I think I see enough of it to have a view, but to have a full, take a step back, what does this really mean? Again, going back to, I'm not smart enough to fully articulate it, but it is
You're a lot smarter than you pretend to be. So
I don't know
don't
about
sell
that.
yourself short, because
I don't know about that.
What you're going to say in the next 5-10 minutes of the podcast is more insightful than you're going to give it credit to be. But we all know better because we know you.
All right. Well,
so give us your take on what's going on.
So it is going to happen, and it is going to be more powerful.
Can I tell a quick story first?
Sure.
This is just a fun aside. So, unfortunately, Jim's not sitting here with us, but he's part of the story. And it happened recently, just a month ago or so, 2 months ago, when we had dinner together in DC, and Jim came a bit late, which
as the Columbia team is like to do.
And we're talking about something. There's a couple other people at the table, and that's to do with the wireless spectrum or something or another. And the conversation goes, and you start talking, and all of a sudden you're grabbing your leg and you're looking at Jim, and then you start telling again, and you grab your leg and look at Jim again, and Jim's like, "Don't tell all of our secrets."
Oh yeah. So
don't tell any secrets that Jim's going to be kicking your leg about.
I'm going to get a big virtual leg kick underneath here. So if you take a step back, and Jim, feel free to kick me virtually whenever you want, but you take a step back, the size of and the force by which this is going to change the way we live and work is not appreciated yet by me or most people around this. There are a couple ways that you would unpack the forces that are being unleashed here. One of the ways you would look at it would be the amount of money being spent. So if you look at the hyperscalers, so this is a lot, when I say hyperscalers, this is Amazon, Oracle, Google, Microsoft. The amount of money that is being spent on the infrastructure that will be running AI is second only in the global space to oil and gas. So the amount of money being spent on digital infrastructure over the next 2 to 3 years is bigger than all the money spent in transportation, all the money spent in manufacturing, and pick a monster industry, healthcare. I mean, so the quantum of capital that is being applied to this problem is nothing like we've ever seen ever in kind of the formation of an industry. Amazon Web Services did not exist in 2007. It kind of launched at the same time as the iPhone. It is a $29 billion business growing at 27% a year. It's so
which is insane.
Just the numbers are so darn big. It's hard to get your head around. And so what you see is there's now this kind of latent capacity to do things that will have implications we're just beginning to understand. So the implications to the workforce, I think a significant number of jobs or tasks will be automated. Now, how those employees go on to bigger, higher tasks. I was in a meeting last week where someone was talking about automation of tasks in a specific department of a bank where they were going to automate, they thought, between 75 and 85% of tasks. So now are those employees able to do better, higher work? Great question, but it's coming, and the connectivity and the force at which this is happening is something that people just don't understand. And from the vantage point that we have at Columbia, we see a lot of it. We don't see all of it clearly, but it's bigger than most understand. People are now beginning to understand the power, the implications on power globally, like how much of the power is going to be consumed by this new technology. But it kind of rolls onto water, it rolls onto geopolitics. There's a bunch of things that are going to be happening, and frankly, societally, what is going to happen is something we'll all be living with for the next 10 to 15 years.
Yeah, I think when you think about the effect on people, which we don't know, we're going to learn over time, but there's some things we could start to acknowledge, and there's some good news and some bad news in this. So the good news is if you're early in life and you want to live a life of leisure, you will probably have more of an opportunity to live a life of leisure with a higher income than probably has ever existed in time, because there is other things that are going to do work for us, and one of the outcomes is going to be a lot of people are underemployed, but there's going to probably be more wealth available for them to kind of take care of their daily needs. And the question is, will they get bored, or will they find ways of entertaining themselves? Will they find some kind of contentment? But a lot of people, if you want to live a life of leisure, that maybe there's a good news thread in that. The problem is, if you don't want to live a life of leisure, you might find yourself, not having a big choice. That might be the primary thing available to you 10 years from now. So there's a good news and bad news aspect to that story. I think the good news, if you are ambitious, if you run into this technology, if you embrace it, if you do everything you can to try to stay ahead of it, you're probably going to be way more valuable as a professional than your counterpart 10 or 20 or 50 years ago could have ever been, because you're going to be able to take the powers of Gen AI and these other things and get so much more leverage out of yourself. So certain people will rise to that and accelerate their careers, accelerate if it's financial wealth they care about, their ability to generate fiber wealth. But then there's going to be another grouping of people that if they're less able to do that, or less willing, or less ambitious, or slow to take advantage of that, or they miss their window of opportunity, the ability to kind of remake up that ground is going to get harder and harder. So you can really quickly be left behind on this as well. So we have a small team, maybe a dozen or so folks, and I'm already bringing my old Dan out, the crucifixion side of Dan, saying, you guys are going to need to look in a mirror, and you need to, each and every individual, a couple of them are here in the room, and you're going to have to ask yourself, are you willing to get in front of this? And by the way, if you want to stay here, as part of our team, you have to. That's a requirement. But look beyond that, because you say, well, I don't want to stay here that bad, and I don't really care about that. This isn't a cruise of interest thing. This is a professional thing. If you want to have a professional career, you're going to find out the hard way that is a truism probably wherever you go, unless you go hide in government or something like that. So you better be running into this.
Ain't no place to hide in government anymore.
Well, you can hide in government for a long time. Yeah, you get protected in government. Maybe if you're in the crosshairs of Doge, you might have a problem. But my guess is there are going to be plenty of places that hide in government for a long time. But if you want a thriving career, man, you better get in front of this AI thing.
I mean, just again, thinking about the analog, if you were a finance professional in the 1980s and you didn't learn spreadsheets, you were not a finance professional in the 90s.
That's yeah.
You know, and to be a professional.
If you think of yourself as, you're in your 40s in that era, like, oh, do I really have to learn these spreadsheets? Because you wouldn't have been wired that way. You wouldn't have,
Yeah.
Spreadsheets were so weird if you didn't grow up on them. It was so abstract. It was so different that, a lot of people who would have been kind of mid-career at that point, learning how to use spreadsheets would not have been a simple task.
No. And I think a bunch of us who are either later stage or midstream in our careers, you've got to make that decision. And it needs to be an active decision that you are going to learn how to work with this technology. And because if not, it probably didn't end well. But going back to your original question, what do I see from my perspective on this? I think if we look forward 5 years and you could project what you think is going to happen to workforce, to how people communicate to each other, to how people relate to each other, there are going to be things that are going to come out 5 years from now that people will say, of course, that's the way we're doing it. And we should have seen it back then. But think about in 2006, you and I were running around investing in technology and doing stuff together in 2006. 2007, AWS and the iPhone is invented. And think how different the world is now.
Good we were buying Fiverr in 2007.
Better lucky than good, Dan.
Yeah.
Better lucky than good. But we're probably at a point right now in kind of the evolution of this technology where you've got a bunch of business models and things that are happening that may have been introduced a year ago, 2 years ago. We look at what the implications of those are going to be, and we're just beginning to get our heads around it.
Well, the good news for me, maybe not for you, the good news for me is hopefully by the time we drop this podcast, we'll be under a term sheet on a deal, and then I won't blow it by this podcast coming out, on a deal that will make all these power sources that need to power these data centers to support these GPUs, it'll make that obsolete. And it's not quantum, it's conventional. It'll take at least 10 years to develop, so I guess you'll have a 10-year run at it. But if this technology works, which it will eventually, because there's reason to conclude there's no question it'll work, but it's one of those where that's the easy part of saying that. The hard part is when will it work and who will get it to work. But I think there's a good chance we're going to make a bet on a company that once this approach works, the need for massive power centers to power massive amounts of GPU capacity, there's going to be a path where there's a way of doing Gen AI that doesn't require that type of hardware that requires that kind of power consumption. So we'll see.
Well, that sounds like a hell of an opportunity.
Yeah. Still science, not engineering.
Mm-hmm.
But maybe past science. Still strong physics component. But got a long ways to go before it's commercialized technology. But really interesting, really promising, and the people are doing it have been doing it, working on it for quite a number of years, and they're ready to try to make a go at it. So good stuff. So what other words of wisdom before we kind of start to wrap up?
I'd say, a couple things. One, I have a tremendous amount of gratitude towards you and, frankly, the opportunities I've been given, kind of in and around this space, and the ability to learn and partner with people like you and people you've introduced me to. And I think if I'm to kind of reflect on the past 20 years or 25 years, what has been a I've learned a bunch of things and been involved in some things I'm really proud of. It really gets down to, and Fleming says this all the time, growth is an antidote to a lot of problems. And so being lucky, I feel I'm really lucky to have been involved in an industry that's been as dynamic and with as much growth. And ultimately, it just comes down to I'm even more blessed by the people I've had the ability to work with, because there are a lot of great business ideas out there, but there are not a lot of great people who can execute on them. And I think I consider myself just lucky, whether it's you or Brady or Neil or Cook or Bruce or Danny Bottoms or any of these guys I had ability to work with. I'm just lucky that they took me on as a partner, and I'm glad to have done it for a while, which is fun. And thank you for all the years and the stuff we did together.
Yeah, well, thank you as well. And I've had obviously time to reflect at this stage of life. When you're working your ass off trying to run companies, public companies, you're barely kind of getting up for air at times. And but now I've had time to kind of reflect back. The whole book gave me even more opportunity to really relearn what happened and big parts of the story that I didn't even know, even though I was sort of part of. So you start connecting the dots, like, oh man, I didn't realize that. But when all the dust settles, what you keep coming back to is the people that, that you cross paths with, the people who you develop relationships with, the fun and fond memories you had with people. It's all about the people. And, when people ask me now, kind of, any advice, it's like, assume the people now and that you're working with, there's a good chance, at least for me, if I would have known then that those same people I would be interacting with, 10 years later, 20 years later, 30 years later, maybe I would have thought about things a little bit differently. Maybe I would have been less successful because I wouldn't have been as ruthless at times. But that's what you're going to care about most. Had a great golf outing a couple weeks ago with Glenn Russo and Kevin Dundon and Marty Panigat too, who's an old lifelong friend. And boy, we played golf. They came up, to Mountain House, and you just start, going back to those moments. Remember this, remember that, and how you met, and who you did stuff with, and that's what matters at the end of the day. And I'll put at the very top of my list of people who's I appreciate the relationships. You and Jim Fleming, always, quickly. One other name we'd be remiss if we didn't recognize here. We talked about, MC, we talked about Gillis, certainly Jim Wade, but the other person who was
Peter,
absolutely critically important, was Peter Claudy, who was a huge part of our ICG. He ended up passing away shortly thereafter, but he was right there in that mix as well. But it's that grouping of people means as much to me from a professional and personal standpoint and a growth standpoint as all the others I worked with as an operator as well. So thank you for being a big part of that.
Well, I appreciate it, Dan.
Thank you for listening to this episode of The Bear Roars. If you enjoyed the episode, please like and subscribe on your listening platform. This podcast was produced by Loud Bear Productions and edited by Kendall Weinberg, with support from Gibson Seeger, Katie McDonald, and Elise Pettigrew.